Right now, if you walk into a bank in London or New York and buy gold, there's a good chance you don't actually own a single ounce of physical metal. What you own is a promise, a piece of paper that says someone, somewhere, in a vault you'll never see, technically owes you gold. And for the last 50 years, that's been fine, because nobody ever really asked to cash it in. But China just built a system where that promise doesn't work anymore, where the metal actually has to move, and they're doing it on purpose, right now, in the middle of one of the strangest gold markets we've ever seen. So here's what's actually happening, why China is doing it, and what it means for your money, whether you live in Ohio or Osaka. Because this isn't really a story about China. It's a story about who gets to decide what a dollar and an ounce of gold is actually worth. Let's start with the basics, because this stuff sounds complicated, but it isn't. A gold exchange is just a marketplace where people agree on a price for gold and trade contracts based on that price. The two biggest ones in the world, historically, have been in London and New York. London runs on something called the OTC market, over the counter, which basically means big banks quietly agreeing on prices with each other, mostly on paper. New York runs through COMEX, a futures exchange, where you can trade a contract that represents gold without ever touching an actual bar. Here's the term you need to understand to get the rest of this: paper gold. A paper gold contract is a financial promise. It says, this represents X ounces of gold. But in most cases, almost nobody who buys or sells that contract ever asks for the actual metal. They just trade the promise back and forth, betting on whether the price goes up or down. And because almost nobody demands delivery, banks and exchanges can issue way more paper claims than they actually have gold sitting in the vault. Estimates over the years have put the ratio of paper claims to actual physical gold somewhere between 100 to 1 and 250 to 1 in the London market. Let that sit for a second. For every real ounce in the vault, there could be 100 people holding a piece of paper that says they own it. Now, why does that matter? Because when the number of claims massively outweighs the actual supply, the price you see quoted isn't really coming from real buying and selling of gold. It's coming from speculation on paper. And that's what China is targeting. There's a concept called price discovery, which just means figuring out what something is actually worth based on real supply and real demand. China's argument, and it's a pretty credible one, is that you can't get real price discovery on gold as long as the market is dominated by paper contracts that never touch actual metal. So if you want the real price of gold, you first have to shut down the casino that's distorting it. And that brings us to reason number one for why Shanghai matters. China's central bank has been buying gold, physically, for 20 consecutive months in a row. As of the most recent data, the People's Bank of China has pushed its official reserves to around 2,346 tons. In June alone, they added about 15 tons, the biggest single monthly purchase they've made all year. And here's the detail that should stop you cold. They did that buying during a stretch when gold prices had actually fallen by roughly 16%. Most people sell when prices drop, and buying feels scary. China's central bank did the opposite. They bought more. That's not a trader trying to catch a bounce. That's a nation quietly, structurally repositioning what it holds as money. And even that official number, as big as it sounds, is probably an undercount. Multiple gold market analysts have pointed out that China's actual buying, once you account for purchases routed through state banks and other channels that don't show up in the headline PBOC number, could be many multiples higher than what's publicly disclosed. Right now, gold makes up less than 10% of China's total reserves. The United States, by comparison, holds something like 70% of its reserves in gold. China has a lot of room to run if the plan is to close that gap. Reason number two. China has been systematically shutting down retail paper gold trading inside its own borders, and the timing is not a coincidence. Starting this summer, some of China's largest financial institutions, the Industrial and Commercial Bank of China, the Postal Savings Bank, Ping An Bank, China Guangfa Bank, all pulled the plug, one after another, on paper gold trading for ordinary retail investors. If you're a Chinese citizen who wants to speculate on gold through your bank account the way you might trade a stock, that access is getting switched off. The official reason is investor protection. Gold's been volatile, retail traders have been getting hurt, and the government stepped in. And there's some truth to that. China's banks also raised something called the margin requirement, which is the amount of collateral you have to put up to borrow money for a trade, to a record 140%. Think about what that actually means. You now need to put up more money than the position is even worth just to place the bet. That's not a small adjustment. That's the door closing. But the unofficial reason, the one that lines up with everything else China is doing, is that they're clearing out the leveraged, paper driven side of the gold market on purpose, at home, while simultaneously building a brand new system in Hong Kong and Shanghai together, designed to settle gold in the real physical stuff. They're not just shutting something down, they're replacing it with something else on the same calendar. Which takes us to reason number three, the infrastructure. Hong Kong has been expanding its physical gold vault capacity from around 200 tons to more than 2,000 tons. That's roughly a tenfold increase. Now, stop and think about that from a purely practical standpoint. You do not need a vault that size to run a paper casino. Paper doesn't take up space. You need a vault that size if you intend to actually move, store, and settle real metal at scale, again and again. The plan is for Shanghai to function as the vault and the reference price, a market built on physical delivery, where trades require the metal itself to actually move. When real supply and real demand determine the price instead of a mountain of speculative paper betting on tomorrow's number, that's real price discovery. And Hong Kong becomes the international gateway into it, since China's own capital controls make it hard for foreign money to move freely in and out of the mainland exchange directly. And reason number four, maybe the biggest one, currency. If China controls the price of the most trusted form of money on earth and settles that price in its own currency, the yuan, it hands the yuan something economists call an anchor. Not an official gold standard, nobody's saying that, but something that ties expectations of stability to a currency that the rest of the world doesn't fully trust yet, mostly because it's still tightly managed by the Chinese government and isn't freely traded the way the dollar is. Gold pricing in yuan, backed by a system where the metal is real and the vaults are real, is a credibility injection. It's China saying, trade with us, settle with us, and we'll back it with something everyone already agrees has value. Okay, quick pause, because I promised you something useful, and I meant it. If any of this is making you think about your own retirement savings and whether they're overexposed to paper promises the same way this global gold market has been, I put together a free guide specifically on protecting retirement accounts during exactly this kind of shift, the kind where the ground under the financial system is quietly moving. It walks through what diversification actually looks like when trust in paper assets is the thing being tested. Links below, or scan the QR code on your screen right now. Costs you nothing, takes a few minutes. Okay, back to it. So let's zoom out, because this pattern, a major power deciding that the existing paper-based money system doesn't serve its interests anymore, is not new. It has happened before, and looking at exactly how it played out last time tells you a lot about where this is headed. Go back to August 1971. Richard Nixon goes on television on a Sunday night and announces that the United States is suspending the convertibility of the dollar into gold. Up until that point, under the Bretton Woods system, foreign governments could technically show up with dollars and demand gold in return at a fixed rate of $35 an ounce. But by 1971, the US had been running deficits, printing money to fund the Vietnam War and domestic spending, and foreign governments, France in particular, had started actually doing the math and asking for their gold. The US didn't have enough to cover the claims. Sound familiar? So Nixon simply ended the promise. No more gold backing. The dollar would float, backed by nothing but faith in the US government. Economists at the time called it temporary. It's been 55 years. What that moment actually did was birth the modern paper money era, and eventually the paper gold trading system that dominates London and New York today. A system built entirely on the idea that as long as almost nobody asks for the real thing, the promise is as good as the metal. China looked at that history and concluded the promise is exactly the weak point to attack. Now jump forward to 2008. The global financial crisis wasn't fundamentally a gold story, but it's the second parallel, because it's the moment the entire world got a crash course in what happens when paper claims turn out to be worth less than everyone assumed. Banks had been selling mortgage-backed securities, bundles of home loans repackaged and rated as safe, when in reality, a huge chunk of what was underneath them was garbage. For years, almost nobody checked. The paper traded, the ratings agencies stamped their approval, everyone made money on the way up. Then, in September 2008, people started asking a very simple, very dangerous question. What is actually backing this thing I'm holding? And when the honest answer turned out to be not much, Lehman Brothers collapsed in a weekend, and trillions of dollars in paper wealth evaporated almost overnight. Not because the underlying houses vanished, but because the confidence in the paper claims on top of them vanished. That's the mechanism China is trying to protect itself from happening to its own reserves decades from now, if the world ever seriously questions what's actually backing the dollar and paper gold system the way it questioned mortgage bonds in 2008. Here's an analogy that I think makes this whole thing click, and I want you to hold on to it because I'm coming back to it later. Picture a casino. You walk in, and instead of handing you actual cash for your chips, the casino hands you a laminated card that says, "This card is redeemable for chips at any time." Fine. Most people never actually redeem it. They just trade the cards around the table, betting on hands, buying, selling, borrowing against the value of their card. The casino, meanwhile, realizes something interesting. Since almost nobody ever asks to cash in, it can print way more cards than it actually has chips to back. 99 people can be holding a card that says one chip, and the casino only needs to keep one actual chip in the drawer, because the odds of all 99 showing up on the same night to redeem are basically zero. That works great for the casino, right up until people start getting nervous. And nervous people do one thing: they ask for the real chip. The moment a meaningful number of cardholders show up at the same time demanding the actual chips instead of trading the cards, the casino has a serious problem because the chips simply don't exist in that quantity. That's not a hypothetical. That's the structural reality of a market with 250 paper claims for every one physical ounce. China looked at that casino, decided it didn't want to be a cardholder anymore, and started quietly walking to the cage to demand actual chips, in bulk, every single month, for almost 2 years straight. Now, hold on. You might be thinking, gold is gold. It's the same shiny metal whether it's priced in London, New York, or Shanghai. Why would where it's priced actually matter? That's a completely fair question, and it's the one skeptics raise most often. Here's the answer. Price isn't just a number. It's a signal about who has power over that number. Whoever sets the benchmark price controls the reference point that every contract, every loan, every central bank reserve valuation in the world gets measured against. Right now, that reference point comes almost entirely out of London and New York, markets dominated by paper trading, denominated in dollars, operating under Western legal and regulatory frameworks. If Shanghai becomes a credible, physically backed alternative benchmark denominated in yuan, it means China is no longer a price taker in the most important commodity market on Earth. It becomes a price maker. And a price maker who settles in its own currency gets to write the actual rules of the exchange, instead of just showing up and trading under someone else's rules. That's the entire point. It's not about the metal changing color depending on which city it's in. It's about who holds the pen that writes down the number everyone else has to accept. Let's talk about who's actually doing this, because it's not some vague abstraction. It's specific institutions making specific moves on a visible calendar. The People's Bank of China, the central bank itself, has been the buyer behind that 20-month streak. The Shanghai Gold Exchange, established back in 2002 under PBOC supervision, is the physical trading venue, the world's largest by physical volume, running contracts like the AUT+D that require actual settlement. The Shanghai Gold Exchange International arm, set up in 2014, is specifically built to let foreign capital and foreign banks participate without breaching China's capital controls. And just recently, the Hong Kong Precious Metals Central Clearing Company was formally approved as an international member of the exchange, which is the clearing plumbing that connects Hong Kong's expanding vault network directly into Shanghai's settlement system. On the other side of the world, the London Bullion Market Association and COMEX in New York represent the incumbent system, the one built on paper claims that China is explicitly trying to route around. Meanwhile, the World Gold Council's own data shows this isn't just a China story. Central banks globally bought over 200 tons in the first quarter of this year alone, with Poland, the Czech Republic, and others joining the accumulation trend. This is a coordinated, multi-institution, multi-year infrastructure build, not a rumor and not a one-off headline. Quick second reminder, because this matters, and I'd be doing you a disservice not to mention it again. If you've got $100,000 or more sitting in a retirement account, and you want to actually sit down with someone and walk through what a shift like this means for your specific portfolio, not generic advice, an actual look at your numbers, I've got a free one-on-one educational web conference set up for exactly that. No cost, no obligation, just a real conversation about protecting what you've built. Details are with the guide. Link below, QR code on screen. All right, let's get back into it because there's more to this than just China. So let me tie this all together. What China is building isn't a single move, it's a stack of moves that reinforce each other. Buy the physical metals steadily, for 20 months and counting, regardless of price swings. Shut down the paper casino domestically so retail speculation stops distorting what the price of gold even means inside China. Build the vault capacity in Hong Kong tenfold to actually hold and move real metal at scale. Wire that vault network directly into the Shanghai exchange through new clearing approvals. And do all of it while your own currency is trying to earn enough global trust to be settled against, anchored by something the whole world already respects. Remember the casino. China isn't trying to burn the casino down overnight. It's building its own table next door, one where the chips in the drawer actually match the cards in circulation, and slowly inviting the rest of the world to come play there instead. So, what does this actually mean for the three things most people reading this care about? Stocks, gold, and the dollar. For gold, the structural case is straightforward: persistent central bank demand. An entire generation of institutions building physical settlement infrastructure, specifically because they don't trust the paper system. That's demand that doesn't disappear on a bad headline day, even when short-term prices pull back 16% in a quarter, the way we just saw. For the dollar, the pressure is slower and quieter than most people expect. This isn't a story about the dollar collapsing next month. It's a story about the dollar's monopoly on trust getting chipped at year after year as more of the world builds alternatives it can settle through if it ever needs to. And for stocks, the honest answer is that markets have mostly shrugged this off so far because it's a multi-year structural shift, not a Tuesday morning shock. But structural shifts are exactly the kind of thing that eventually shows up in interest rates, in currency valuations, and in how global capital decides where it feels safest, which touches every asset eventually, including the ones in your 401k. Here's the thing I want to leave you with. Nobody running this system is telling you it's an emergency. Nobody's claiming your savings will be wiped out next week. What's actually happening is quieter and, frankly, more convincing than any fake deadline could be. The people who run the biggest financial institutions on the planet are positioning themselves, deliberately, patiently, month after month, based on real data you can go check yourself. The question was never whether something dramatic is about to happen tomorrow. The question is whether you're paying attention to what's already happening, slowly, in plain sight. If you want help actually applying any of this to your own retirement savings, the free guide and the one-on-one web conference I mentioned are both linked below, along with the QR code on your screen. No pressure, just information, so you can make your own decisions with your eyes open. I hope you have a wonderful rest of your day, and I'll see you in the next one.